Hey, what's up?
Well, how about you?
Not too bad. Yeah, I'm just updating my models here, post learning, and it really, forced me to um like to make sure that I have a note down on things that I need to change and things that I don't need to change.
Nice. Do you cover Nikola?
No,
Is that because it's not EV?
it's how can I put this? Um, it's
Driven?
like no, it's
It
I
is.
just I just don't think like I went down this rabbit hole of fuel cell vehicles before. Um and that was around 2017, 18. And I realized the world actually chose to go EV rather than fuel cell. So we as a society as a whole decided to pitch, or to turn that way. So I think there's no point doing fuel cell anymore.
Interesting.
Um,
Yeah,
so
Nikola's.
So
Uh,
back then, there was this argument, right? So it actually, costs a lot of money to compress hydrogen into this liquefied form and then ship it around the countries into like what you can call it like gas stations, same as hydrogen stations, and then fill that into the tank, and through a combustion process you'll generate basically water. So there's like no carbon dioxide can be emitted from the combustion. But the issue is the cost of that is so high. If you don't have any scale, like you won't be able to have like liquefied hydrogen and then like ship it, or like compressed hydrogen, ship it around everywhere. And it's somewhat dangerous as well because you're playing around with like pressurized gas. Um, and there is an argument to be made on trucking. I guess that's what Nikolai is trying to do, is they like on major shipping routes, it is easier to set up these hydrogen, fuel cell tanks in the you can call it charging station or like filling stations. Um, but then that didn't really catch on, as a trendy topic. So I don't see any of the consumer applications here. The only application will be in the commercials, but Tesla semis coming out next year to compete directly with those long haul trucking business, and they have a like vertical integration. They have like autonomy. Like they have all the other amazing tax that comes with it, rather than just like like a driving format or fact like like the way like how you drive a wheel basically. They have so much more than that. um so yeah, on Nikolai, I'm not super pumped. I don't want to trade Ascot too. They're making like 44 trucks like this year or something. I think I saw in the Q1 earnings report.
or Nikola?
um Nikolai, yeah.
Well, yeah.
And they live on these like huge subsidies. It's like I saw on the website like $300,000 subsidy. Basically means no one's really buying.
Yeah. I'm
And it's
seeing like 2000 negative 2000% gross margin.
right. And it is a business where you need like extremely reliable vehicle. So like because trucking, it's a very expensive business, and like you gotta buy a truck, it's a big capex spending. And if the truck breaks down, you can't ship anything, and that's like a really big loss to to the operator of the fleet. So I think they will be more interested in like more like proven or reliable tech than venturing into something that's completely um, you know, like novel. Um, and with the hydrogen battery, there's also another issue is that it in a downhill situation, which is where the trucking is most dangerous, you don't generate that much electricity because your system built around hydrogen, although you have the battery, you have the inverter, but if you have a full electric system, you can actually regenerate electricity on the way downhill and then save on your brakes because you have those motors decelerating as you go downhill. So it's like slowing you down effectively. If you like, if you drive an electric vehicle, when you lift off, it's like regenerating through the inverter. So you don't need to use the brakes. So that's like a huge plus in trucking business.
How much
Like
more distance do they get from that?
so you will like recoup like some of the energy used uphill. Actually, Tesla had this one test where you go from San Francisco to San Diego. Like right before you go into Los Angeles, there's this big hill you need to climb and come down. So like I look at the chart of the range, right? So yeah, like the range took a hit when it's going uphill, but on the way down, it's kind of like it regenerate back to the normal trajectory. So in a normal truck, like in a gasoline powered truck, you don't have that. Like all the energy is wasted through the heat generated by the brake. And the brake overheat, and that's why you see those big like truck ramps that, if you lost your brake, just go for the ramp, instead of going downhill. So it's a huge it's definitely an interesting topic when using electric motors in something that has like several tons um of I won't call it several, but like definitely more tonnage than an average vehicle you drive every day. So like at least 20 or 30 times over. So
Hmm, nice. Yeah.
so that's where the argument kind of break down for the fuel cell. Because like at the end of the day, right? What you want is actually a rotational force around the shaft. That's it. So like whatever is the easiest way, so you to like make that motion possible is like the most elegant way right now is electric motor. Like I'm a huge car fan. I love like ice cars. I love the sound they make, but I gotta admit it's not the most efficient way of delivering power. So fuel cell is not a step change function. It's just another way of using combustion or chemical process to generate a rotational force around the shaft. But electric motors, they just do electromagnetic force around the shaft, which is much more efficient. Um, it's a bit like, you can have those like $10,000 like Rolexes, but it tells the time the same as like your Casio $10 Casio tells the time much better than a Rolex because it uses an electronic chip rather than like those like very complex mechanical process. It's beautiful to watch, but it's just not efficient. Like you're like 10 seconds out of sync every day. Um, you don't see those special forces wearing Rolexes, right? They're all wearing those Casios. So I think that's the analogy I would use when you compare like fuel cell trucks versus EV trucks.
And the
Um,
subsidies are because the government are interested in seeing where this goes.
Right, and I think it's losing it. I mean, I don't think the government is actually, pulling back on the credit. I don't think that's the case. But when the government's dumping all these money to try out new, ways of transportation, um, and I think it just lost the battle.
Hmm.
So yeah, I think it's one of those moment in time when the whole society decides to go to one way, and then that's you know how we chose to go. It's like AC versus DC,
How
right?
about
Like
rocket
back in the
fuel
day. Rocket fuel for what?
for cars? Is that a thing?
No, still not efficient enough.
Hmm. Shame.
It's cool. I mean, you'll get like tons of speed out of it. Like that's what the land record vehicles do, right? They strap on rockets at the back of the cars. Um, yeah, like one, it's not efficient. Secondly, like imagine you're walking down the streets of London and then you're crossing a road and tons of cars with jets, like thousands of Celsius just burning your
They
skin.
they cook you. Yeah.
That's not a good look, right? Um, yeah, so
Hmm.
yeah, I was a big oh, hi Mo. I was a big
Maybe so.
advocate for like fuel cells, back in 2018, 19, and then after the
Hey guys.
COVID, I feel like it's just dead. The whole field is just dead.
Well, there was some shenanigans at Nikola, right?
Yeah,
I
there's
recall that
also that.
was,
Yeah, like fraud, right?
yeah.
With the specs and all. So that's why I want to stay away from that. For it's more interesting to go into regions that are more um has more secular growth than fuel cell. So yeah,
Hmm.
that's just my take. Mo, how's your day? The market kind of pretty happy with the initial Jarvis claim, but is it again a facade?
Yeah, I think it's a little bit of a facade. I mean, one of the things about the data is this morning was, I mean, we knew that it was going to be like an inline print. It
Mm-hmm.
came in a little softer, right? So it came in at 233 versus the 240 in the
Mm-hmm.
survey. Um, nothing too much to really read other than, it does look like you're not getting that regional decomposition that I think people were expecting. Uh,
Mm.
but I it's really going to be in the last 2 weeks of August that I expect the data to start to kind of point in the other direction.
Mm-hmm.
Actually, this is interestingly enough, but ZipRecruiter had their earnings recently, and one of the key things that management said on the call was that in the last 2 weeks things have gotten worse.
Okay.
Yeah, so they were gonna say that we thought that we saw data troughing in July, but
Mm.
then in the last 2 weeks we saw data get worse, and
Interesting.
so I thought that was pretty interesting because ZipRecruiter is a recruiting website, right? So
Yeah.
they see a lot of this. I mean that's obviously like an anecdotal bit, but
Yeah,
yeah. So
just adding like one more anecdotal evidence. I think I saw a headline aftermarket that Paramount is cutting 15% of their workforce. So I mean, just like another industry join the ranks.
yeah, I'm a big fan of you. Do you use Warn Tracker?
Yeah, yeah, I saw like the Warren tracker. Yeah.
So I mean, they have a really good database of layoffs, and you can see how the amount of warn notices has risen. Um, it's actually really interesting to see, how this is kind of, coming out. So, now the one thing that I should say is like, warrant notices right now, I believe for the year are just about like 1,800. And so it's not like spiking. But the thing is, it's definitely kind of moving. It's these are the things where it's like, um, the smaller companies have already been impacted. So you're not going to get necessarily like an increase in like the total number of firms that have warrant announcements, but you will just see that the size, um, the announcements gets, will get worse. So, if you look to like, and this is kind of what I recommend, like looking at in 2009, the total layoffs were running at 165,000, and there were 1,500 warrant notices. Today, there's 143,000 people laid off, and then warrant notices are at 1,857. So, like the key thing is, and this falls back to the discussion around the beverage curve. Once you get down to that downward sloping side, just things just start to move in nonlinear fashion. So what does this actually mean? If you look at the past couple of years, so since COVID, right, you've seen that actually, warrant notices and layoff rates have actually, uh, you know, you could actually say since 2014, there's been like a bump in the level of warrant notices and layoffs. And then after COVID, you kind of had a peak, like a post-COVID peak that happened in 2023. But the level that we're running at is still just like very elevated relative to, and this is what's important, is that like we're pretty high, and this is where like, a marginal change in the employment rate, right, is more meaningful. So the kind of signal that you want to take from this is, unless this compresses dramatically over the next, say, 4 to 6 months, you should expect that if we run at the same level of warrants, that the unemployment rate should accelerate higher, right? Because the labor market is now in a state of slack. So that's the way that I would, interpret this. I think if you the wrong way to interpret it would be to look at it like a time series and try to like say, oh, we're at a peak or a trough. You really just want to understand, like, given the regime that we are in for employment, where are warrants? And if warrants are persisting, then it just means that you get at further like an accelerating unemployment versus if you saw a compression. So that's like the key thing that I would pay attention to.
Are you saying warrant?
Yeah, I'm saying warn. Warn notices are notices that companies have to publish with the local municipality if they're doing a layoff over a certain number. I think it's like 100 or something.
Okay, thanks.
All right,
Cool.
thank
So
you.
yeah, that's really what I'm seeing there.
Yeah, it's just very light in macro. I mean, I just feel like, I mean, I was kind of like awake when the prints came out. It's just, I mean, I see like the market reaction. I feel like market's kind of like a little bit like schizophrenic about like this print. It's just me, it's just like macro volatility is there. Um, yeah, I mean, beside that, I mean, the Fed watch is still pricing like 4.1 cut by the end of the year. The rate market sees a little bit bear flattening, I think, during the day. I haven't like checked the close. 2 tenths from like -2 to like -5. Yeah, so it's flattened a little bit, but yeah. Um, yeah, I mean, beside that, I don't really have a lot to cover. I mean, just like this jobless claim is probably like gaining the headline. I think the more interesting stuff is over the equity side.
Nice.
Yeah, how's the trade desk? Like, I saw it was like trading like 94 after hours.
I mean, uh, strong performance. Um, in the quarter, this really kind of hit the upside thesis. So it's pretty pleased about that. Like the big, I think I mentioned that like the big thing was the impact from connected TV, and then if that was going to be, and then also like the S&P environment, and whether that was going to be offset or if that was going to get impacted. And then I said how the other day we saw Roku, which is the CTV vendor, and they actually performed. They reported very well, and so that was like the positive read through for the trade desk. So yeah, I'm expecting a pretty decent move up. I haven't repriced it based upon like the new information. Like I haven't fully updated my model yet. I just literally put in like the bare bones for the call, and then I just got done with my notes before we hopped on. So I'll be thinking about it for like 30 minutes after, or after a call, and give an update on where I think the price is going to go. But yeah, really strong performance, and I think the big thing is that Google cookie issue was like a major headwind. That's gone. And then the other thing too is I mean so just like the highlights, like going into the quarter, it was you had Google reporting and YouTube missed on ad growth, and that was kind of like a really worrisome thing across the ad tech industry. um, that was the reason why I was a little bit more cautious going into the quarter. But when Roku reported, remember that there's a difference between like the way an advertising works on connected TV versus how it works on, say, a YouTube platform. But it looks like the growth in CTV is really driving. Like that's really the scenario that's hitting. So that was really good. Um, yeah, guidance was very positive. They also mentioned that two things that I thought was really key was they mentioned that their $60 billion in programmatic market is growing. So like the TAM is rising. And then they also mentioned that they have like a unique access point to China. And I think that's probably going to be something that people are going to really track onto. I want to go back to like my Roku notes because
Okay.
actually, but that's kind of the way that I'm seeing it right now.
Yeah.
Did you take that little butterfly?
I did, yeah.
Yeah, I did too. I have the 100, 110, 120 fly we talked about.
Nice. So one of the things that I'll say is one of the like big things that they did not talk about, okay, or like still like a little bit of a concern is okay. So we know that like Apple and Google are moving into a walled garden environment. Um, so this is obviously a headwind for a third party like the trade desk because they have to go through an Apple or Google. And Apple and Google are obviously going to want to retain and own the like the customer data, you could say. So the Trade Desk had its like cookie replacement tool called UID2, but ever since the Apple and Google shift towards like changing cookies, like Apple started it first with ATT, like they this actually really impacted Meta a couple of years ago, but they kind of started this chain reaction. And so one of the underlying things that really wasn't addressed like fully was again like a post cookie environment. So I think that that's something that's like still impacting into the Trade Desk. They just kind of doubled down on UID2, which is their like opt-in cookie platform. And I mean the thing about that is that's good, but I'm not sure if it's good enough to really hit the full case, which is tracking for this non-cookie world. Because I think so one of the things that's happening behind the scenes is there are a lot of these startups that have raised money over the past 2 years that are trying to address this like post-cookie world, and there's still that concern that and I think we'll see what happens over the following year, but the concern is that eventually this post-cookie environment will actually will limit UID2 success and penetration, and so that may present headwinds. That scenario is not very likely. That's like a bear case scenario, but because they didn't fully address it, it's still something where it's going to limit like the full rally. If they had said something along the lines of, we are building for a post-cookie world, then I think that actually that would have been more positive. And I think that's what people were expecting when Google was down this path of cookie deprecation or, turning that off. But now that Google has, said, okay, we're actually going to keep cookies, it just seems that the Trade Desk is now like, okay, guys, like we don't need to do anything here. So I don't know. I'm a little, that is a little bit of an issue. However, on the flip side, we've been waiting very patiently for, Netflix traction, and it does seem that is going to be something that'll be like an additional tailwind. So, overall, pretty solid results. It tracked like my baseline, scenarios. Right now, like I'm feeling that like the stock should pin to like 100. It could go to 110. I think that's kind of likely over the next a couple of days. I will want to just reconfirm stuff because I want to see like, okay, with what they're saying about UID and then a change like a rising TAM and maybe like a Chinese market. Now, how does that really change estimates? It's on the call, like when they were first talking about it, it seems like it might be pretty big, but I'm not sure if that's something that is really as is really as big of a moat as what they're saying, So that's something there. But otherwise, yeah, very very solid. So should be good.
Well, let's see. It was up just slightly after market, right? It was up. I had it up, but I lost it. Yes, we closed 88 and 27. We're at 93.90, 94 maybe.
Yeah, about there. Yep.
Yeah. So obviously, there's no. I'm looking at the volume. There's like no liquidity, so this might pop at the open. That might be nice.
Yeah.
Very little trading.
Yeah, I think right now I'm like, I mean, IB is always kind of, late, but I think I'm making like $50. Let's see. We'll see how this goes tomorrow. I think today's like positive macro news was good. That should also somewhat address concerns, but again, it sounds like one of the things that I think they did really well was they did address the like SMB concern. And with their, one of the things that I took away was they really kind of contrasted themselves as winning in an environment where like they're kind of saying, other ad, networks or platforms aren't going to perform as well as we are, so that was kind of commentary that I thought was very interesting. So let's see how this goes. I'll give you guys an update after I really kind of sit through this. I'm like, my head is still, I just got back from the call, so I just have my basic notes right now.
Well, I'm still just, I was pitching an investor, so I got completely sidelined getting prepped for that, and barely got the trades I wanted on today for the close. I was rushing, giving myself another good chance to misclick and click away some steak dinners, but fortunately that didn't happen today.
Nice.
And I shaved, so I don't look like a guy that needs to like crash on their couch just for one more week.
There you go. Although I think that like facial hair is in fashion, right?
Is it still? I thought it was kind of like out of fashion now.
I think it's kind of late. It's like a COVID thing.
Maybe.
Lots of big runners today. So lots of momentum. Some of the earnings like VSAT. Well, it's not a good round. Elan. Oh yeah. Clarivate. Like a post-morning run. Yeah, lots of I hate that I missed the open because I would have definitely had some good trades today.
Nice. I think I that's interesting. I typically, like, when I'm trading, the way that I kind of view trading is it's more of like it's really more about like positioning for things that are happening. So I would rarely like change my views, on the price. Personally, I think we were kind of talking about this earlier on the call, which is a little, I don't want to say that I'm skeptical of the rally, but I don't think we're out of the woods yet. So,
Yeah, so I actually did get short, rather I got long some put verticals in the NASDAQ and the index. Well, actually in the Queens. One, I needed the hedge. I was starting to get pretty long delta, and it was sufficiently cheap now that the VIX is down again another 14% today. So we're kind of getting back into not completely insane zone. With the vertical structure, kind of negates most of that. But
yes.
Yeah, so I've got a bit of a hedge on, and then AppLovin is a company in my coverage that did do well today. It was up pretty good, 14% today. This has been a high flyer for months and months and months, and like everything else, it kind of took a breather. I don't know that I'm going to hold on to it. I might hold on to it for the Pete, or I definitely will reposition it if I do. Yeah, so one of the differences, like, momentum kind of used to be my bread and butter. When there's volatility, that's the thing. When the VIX is at 8, not it's not very helpful. It's not going to work. But up here, we're starting to see some momentum. Stocks that are high in relative volume, that kind of thing. And yeah, like VSAT was the big runner today. I hate that I missed that because that's one that definitely would have been pretty sweet. So I'm hoping that continues for another few days. Get stocks that are gapping and making big moves. But I'm with you. Overall, I've got, as we discussed yesterday, kind of a bearish sentiment. We call a weak short thesis, and a weak short bias. So Hence the hedge.
Nice. Makes sense.
I'm so behind on everything. All my coverage, I'm behind on everything I need to do.
Yeah, that's exactly how I feel all the time too. Like it's
Yeah,
just
like all the time.
yeah, I
Yeah.
feel like I'm on like a hamster wheel and it just never ends, right? It's just like gotta constantly, follow, like one of the things that I feel like that does help me is that the way that I update all my companies is it's just around the earnings. So it's like
Yeah.
earnings print, I gotta go and run my process. And that's not too bad. But the problem is that like every new earnings is somewhat incremental to like other companies. And it's like I know that like, oh, I really want to update my notes on another company, but it's like I haven't gotten there yet because there's just so many companies that are reporting. So this is something that yeah, I think it's just always a little bit of a challenge. But I wanted to actually hear more from you guys today. Barnaby, I want to hear about the Dynatrace Datadog trade that you put on. I think you did a really good job of kind of analyzing the two companies. You went through the process. Tell us about your experience with it and how you ran the trade and I know that you just closed it. And just walk us through the process and how you feel about how you did running the process.
Yeah, sure. So I think it was iterative, and I think your feedback was very helpful. Probably uh, gave me the confidence to do it. I suppose helps that you agreed. Um, but yeah, I was actually initiating on Dynatrace when I read the JP Morgan CIO survey, and I saw that data point, which placed Dynatrace as being the least penetrated among the biggest companies. And in combination with their shift in go-to-market strategy, I figured that there's probably something here. So yeah, the initiation turned into more of like a earnings note and went through the sell side, um, got all of their takes, and this was just a couple of days after that CIO survey, and so none of them had used that data in their opinions, and and then yeah, you had me go through the scenarios, and I went through those a couple of times, laid out the critical factors as well, um, and then you suggested there was a potential trade versus Datadog, so I like reinitiated on Datadog and kind of did the same thing again for Datadog on a slightly lighter scale. And I would say the thing that really gave me confidence to be short Datadog is the fact that they have this. There's so much complaints about the pricing, and then they bring out a product that is going to help their customers reduce their own pricing. And so it just seemed like a pretty optimal situation, really. Dynatrace was kind of short term trading below its multiple, and Datadog was like the opposite. Um, yeah, pretty, I would say, helpful experience to kind of see this process from start to finish. So, so clearly, I will say that I was really, this really took like all of my time doing this for probably like 7 to 10 days across those two companies. But that did include the initiation. So yeah, overall, I'm really happy with it. And yeah, I think the thing I did a bit better this time than I had done before was going a little deeper into which parts of the scenarios I agree with versus disagree with, and plotting whereabouts that puts me on the distribution, which turned out to be really accurate, or at least from the reading in the 8K that I did. I haven't gone into it in depth since the earnings, but yeah, it looks like the thesis was hit pretty spot on. I noticed that Datadog didn't have, they didn't really mention the cloud cost optimization product. I guess there might be like some sort of politics there, given that they're obviously forced to do that because otherwise their customers are just going to switch. So is that normal that if they, for example, bring out a product that reduces costs, you should expect that the analysts might avoid that for the sake of the relationship with the management?
No, I mean, I think, like someone will ask it, I don't think that, at the end of the day, like people care more about the truth, ultimately. And so,
Okay.
no one is going to like budget. They're just, they may be like, the way that they phrase it may be nice, right? Sometimes they might say it in a way that's like constructive. Like, for example, oh, so, great quarter, guys, really, really impressive to see the growth rate improving. Do you think that there's an upside case with this cost optimization tool to like accelerate your buildings growth? Like things like that, right?
Right.
That's the same question fundamentally, but it's pitched in a way that is leading. You will sometimes see that with like quote, like really big quote unquote stock marketers type of guys like a Dan Ives. But I would say generally most sell side analysts are, I don't want to say that they're like more popular than the CEOs, but they definitely have a lot of importance. And so, because at the analysts have a tricky job, right? Because on one hand, they're paid by the buy side. So like ultimately they're going to get paid if they're helpful to the buy side. Okay. But the way that they're helpful to the buy side is that they have corporate access. Like that's how they're helpful to the buy side. So that's a tricky balancing act. But I the sell side is almost always gonna lean on their relationship with the buy side more than management in general. There could be some outliers. Like I said, you could see some sell side analysts that might be like trying to lead the question, especially if they have like a bull case that's like not panning out. Like, say the analyst was like, oh yeah, Datadog to like $500, like Datadog to the moon, right? And is like laid out a thesis that actually they expect that there will be like a surge in buildings growth if the price drops. And then, oh well, buildings didn't exactly surge, right? So the analyst might then try to ask a question to maybe keep that thesis in play. Like you see that would be like reaching or grasping, and not everyone does it. That would be like a very small minority of analysts, that would do that. But you definitely see that. But no one is gonna like not ask a question because they're worried. At the end of the day, you don't necessarily, I mean, I'm not going to say that you should trust, anyone, but you should at least trust in like the group that like, if an analyst doesn't ask a hard hitting question, then the analyst after him is going to look better by asking that hard hitting question. Because trust me, like, investors, buy side guys, PMs like me, like us, if we see an analyst asking hard hitting questions, then we're going to be like, oh wow, I like that analyst, right? I'm going to read that analyst more. I'm going to pay that analyst more. Like that's what it translates into. So like the analysts are also trying to like one up each other in that sense to prove their worth on these calls. And so like getting in the top 3 questions obviously very key. You know, they're very competitive to try to get there, and then also to make sure that they, you know, ask, questions that everyone is going to be like, oh, that was a good question, right? Like that's ultimately like what these analysts are trying to do. So yeah, I hear your concern, but I would say don't think about it as your base case.
So how do they decide the order of questions?
So, during the call, they'll go into this line, a queue, and then it's based on typically like, I don't want to say first come, first serve. It's like a little bit of first come, first serve, and also like relationships. Because like the IR person is going to then select the people. It's just like a press conference. You see like there's like 50 journalists raising question or raising their hand, but the person who's giving the speech, right, they're going to choose who they call on. And if they know people, they're just more likely to call on those people first. So typically the IR person will be like, oh yeah, we just hosted that Goldman guy, or we just hosted that JP Morgan guy. So yeah, I know him, like top of mind. So yeah, okay, they'll go first. So it's not like there's some discretion by IR, on the picking, but that's typically how it works.
Interesting. Do you have a take on the pair after the earnings?
So I really like the setup. I think that the way that you should understand this, Barnaby, is that ultimately there were two things going on. One is like the fundamental backdrop for both the companies. Those represented the constraints, okay? And then two is like, what's the path that's like happening, okay? And so one of the things that, I saw in your notes is that your really, or like your variant perception versus like consensus was really this view on data, or this view on Dynatrace, which was that this go-to-market strategy might actually be more successful than is expected. The analyst community is too conservative in their estimation of how this go-to-market strategy is going to roll out, because they're thinking that the sales team is going to take a long time to like fully roll out. Okay, so that was a key differentiating point that you had versus consensus. And so because of that, your estimates were a little higher than consensus. So that perception, right, is what's key. And so because of that, the market was both misunderstanding the trajectory of growth in the near term and also the terminal growth, like what's going to happen over like 2 or 3 years. The whole curve is behind this, what's happening, right? Because people are extrapolating a growth rate based upon, less successful, go-to-market strategy. So in post earnings, right, we got the update on GTM, which was, they had some good highlights. They mentioned that they're continuing to hire more sales capacity to position for 2024 next fiscal year, which is a very positive sign. If a company is hiring salespeople, that means that they have things to sell. Okay. They also seem to imply that there's less attrition despite all the changes. So one of the things to know about Dynatrace, and I think I mentioned this to you on another call, which was, this is based on like a private network, discussion that I had with a colleague of mine, who said that Dynatrace was really like two teams, two separate firms, okay? CompuWare and then Dynatrace. The CompuWare team is like old school legacy, and they were in charge of sales. So they just didn't know how to sell Dynatrace, which is actually a really good, observability platform. And so with this like change in go-to-market strategy, that's like exactly the right thing to do, because you have the wrong, it's like you have ice cream salespeople trying to sell Rolexes, right? So it's just not a great fit. So what they did was they changed the go-to-market strategy, and they changed the sales teams to get it more in line. And now you have Rolex people selling Rolexes and ice cream people selling ice creams. Or that seems to be like what the company's doing. So what does that mean? It means more alignment, means better sales, means better operating performance. So that was a kind of a key distinction point. I think they pointed to an very much like positive notes across the whole GTM side. Now, for you, the thing that you should think about is like, okay, you have your estimates, the results track to your thesis, has sell side tracking to your thesis. Okay, that's number one. Is everyone talking about this now? You know, the couple of notes that I've seen, there's small mentions, but you know, it doesn't seem like it's fully reflected. So that's one thing, which is like, is the story out? The next thing is, and more importantly, is does the market know? Okay. So you have to think about like your upside scenario, or like your scenario. Is the market pricing? This is the stock price at the level that you were anticipating. Because if the stock price hits your level, then that means that the market, even the market, the increase in the stock price is a multiple expansion, but you know, like because of the reverse engineering that we do, that okay, that's just the market reflecting a higher revenue rate because they agree. Like the market price is implying a convergence to your view. Okay, so that's the thing that if the expectations gap is gone, then you exit the trade. If the expectations gap remains and is still juicy, then you remain in the trade. That's what it boils down to. Now, on the flip side, with Datadog, I liked your approach to Datadog because one of the things that's extremely hard to do when you're, on the buy side or when you're on long short equity is try to find alpha longs and alpha shorts. It's extremely hard. So most of the time you end up playing a spread game, okay? But there's a weak way of playing a spread game, and then there's like a alpha way to trade the spread game. Okay, so the weak way of doing the spread game is saying, okay, well, let me just, I'll do an index, I'll do an ETF, I'll do a basket, and or I'll just do like the closest peer. Okay, no view, but I'll take the closest peer. That's like the weak way. It still can work. That can still be fine if you're a really good stock picker on the long side. Then that's all you really need, to be honest. Okay. But the better way, and this is like a real skill, which by the way is very hard. I don't know many people. There just aren't a lot of people that can generate alpha on both the long and the short side. Like that's the reality. And if, you could, every hedge fund manager and every portfolio manager and every analyst says that that's what they try to do. Very few people have a successful track record and actually generating alpha, on the short side. I even want to tell you guys that even my since inception performance, my short side has a negative contribution to my performance. Now, one of the things I'll tell you about that though is all of that negative contribution came because of that December rally last year. Okay, and that's because the whole old junk just ripped like crazy. If you remove that, I actually do generate alpha on my shorts.
I was short that rally December 1st.
There you go. Nice. Yeah. So yeah, that was super painful. I still generated P&L. Like I still performed, but my shorts absolutely suffered. That also happened in July, but the learning that I had in December helped me manage through July, much better. But that's a key thing. So I just want you guys to know that it's actually like extremely hard to successfully, get long, do alphas on the long and short side. And so like your best case is that you generate good long positions, and then you can generate on average a small positive, or at least you're neutral on the short side. That in and of itself is extremely impressive. Okay, so I just want, this is just me telling you guys what you should expect for yourself. Now the thing is that to even get to that 0% contribution from shorts, you still have to think in alpha terms. Okay, if you didn't think in alpha terms, you might have gotten completely destroyed. So You still have to always think about alpha terms. It's just that shorting is a little bit more tactical and a little bit more dangerous than long, and the reason why is because of the positive carrying equities. Okay, there's like you're swimming against the tide generally with equities, and so that's why there's this like negative skew on the short side. But nonetheless, like I really like the way that you approached Datadog, because what you did was you pretty much got to the point where like, oh, the market was already pricing everything in. If anything, the market was just like a little ahead of expectations. And so that gave you the room to like, it wasn't that you thought that, oh, Datadog's gonna have some material loss, right? That would have been really more focused, like idio sort of a trade. In this case, it was more of that, like you had analyzed Datadog sufficiently to like understand the trade, and you knew that, okay, well, through the period, this is gonna like match up, because you're really seeing the Dynatrace side, bring it in. But because you analyze Datadog from the perspective of trying to get an alpha short, you were able to get to the point where, like, I think it probably had a slight negative contribution, but if you looked at the Sharpe ratio of your trade, it's probably extremely high. So that's something that is, that's extremely valuable. I just want to commend you on that, because that's very impressive.
Thank you. How do you take the sharp of the trade then? You would take the pair and you would just take the time series of the pair.
Yeah, I'm eating late lunch, early dinner, so apologies if I'm a little slow in responding. But yeah, you would just take the time series data of the pair, you do the standard deviation of that over the interest rate. You could do like SOFR or an overnight rate, right? So SOFR would be the best bet. You can do Fed funds rate, if you want, it's fine. Through the period. So like if through the period, you would have generated like, I don't know, like 60 basis points of risk-free rate. You generated a 15% P&L on the trade with a standard deviation of like, I don't know, maybe 6%. Your risk-adjusted return looks really attractive.
So the Datadog short actually was a bigger contributor in the end, and that was after, and that was after they had earnings, which they did. They went up like 4% today.
Right. Yeah. Nice. What was the total split of the two's earnings?
You mean the ratio?
Or just what was like the P&L that you got from Dynatrace, and what was the P&L you got from Datadog?
So I did. I had $4,000 long Datadog. Sorry, long Dynatrace, and then short 3,000 Datadog, and as a percentage,
if you look at
60% came from the short.
Well, like what was your P&L on the short side? Like how much did you make on the Datadog short?
So
what was the price that you shorted Datadog at?
So at 12% on the short side.
Nice. And then what did you do on Dynatrace?
6%.
Nice. Yeah, that's really good. So actually, my question to you is, so now think about what's happening, okay? And look at your estimates, look at where the stock is. Has Dynatrace hit your price objective?
Yeah, I haven't updated, but yeah, it's basically exactly. My target was at least 46 63.
Nice. And when, how many like weeks ago did you put the trade in?
That was oh dear, I didn't track the date.
It was like a
Figure it
month
out.
ago.
Yeah, I think it was less than that actually.
Yeah, so your lesson is that this is a really impressive annualized return.
Yeah.
So
Yeah,
if you can do 5 of these a year, that's already like extremely impressive. If you can do 10 of these a year, okay, now you're probably in a position where, you know, you might actually be able to live off your earnings. If you can do this 5 times per quarter, so 20 times a year, you're a long short equity, you know, hedge fund analyst. So that's what it is, right? You know, at the end of the day, like, you know, you're not going to come up with trades like these every day. You saw how much time you took when it came to the due diligence process, how you evaluated, you know, the opportunity and then set up the pair. And it does take time. That's even if you had the initiation like already prepped, it still would have taken you like at least a couple of days, right?
Yeah. Oh, at least probably, yeah, like
Right.
3 at least.
So what happens is that at the professional level, you'll probably do like you'll aim to do like 20 of these a year, and then you'll have a bunch of smaller tactical trades that you throw in, you know, that are more based around, you know, that you'll have with like much smaller size. Okay, that you'll pepper into your portfolio, you know, on a, you know, weekly basis, pretty much. You know, probably generating, you know, 2 to 3 of those types of ideas. Well, maybe 1 to 3 of those ideas, you know, per week. So on a annualized basis, you're probably generating around 100 trades. You know, 100 to 150 trades per year, where the bulk of your returns come from those 20 trades that you put on. And then you get like a smattering of returns that come from the smaller trades.
You described, I forget which company it was yesterday, as something as a like a beta thesis. And what do you mean by that? And do you still trade those?
Yeah, so a beta thesis is something that like everyone thinks is going to happen. Like it's consensus. And so if you hit consensus, then it really just depends on where the market is pricing. Sometimes the market is not pricing consensus. Like going into an earnings print, maybe the market is discounting consensus. That happens. That's why we actually are trading the market. We just use consensus as like a benchmark for like the metrics, because we need to have it's the variable that we put in to solve for the market's expectation. Okay, so that's kind of how those two things work. If say consensus for next quarter is 100 million for a stock, and the market implies, say the market goes down, or like the stock price goes down like 10% right before earnings, okay, and 10% idiom right before earnings, then the market is pretty much implying a 10% miss, right, to consensus. That's the trading opportunity. Then it doesn't matter. Then it doesn't matter if I have a consensus view or not. But what's really important is that I need to know that I do have a consensus view, and that's why we still every time we put trades in, we still have to go through our process. But the trigger of the trade can be different each time. So there are various different triggers that tell us that there's a trading opportunity. Most of the triggers, or at least for the 20 like juicy trades, are going to be informational events. So for example, how often does Mark Murphy put together that CIO survey?
Like once a year, right?
Yeah, exactly, right? So like, and you might be able to get 1 or 2 ideas off of it. Maybe 3, because I think he has got like over 20 companies that he does on. You might get like 3 you might get like 3 trade ideas off of it. So where are you going to get the rest of the 17? Well, you might get some investor days. You're going to get some conferences, some product releases, and altogether, that's how you're going to generate your 20 potential, ideas. Right. So those are the source. Those typically happen around some informational event. Then these smaller trades occur because of market prices. The market is moving away or towards or overreacting or under expecting something that you think is going to happen. So that's why in the like analyst process, it's like, yeah, like the first thing you do is pre-market, you want to see, hey, has anything changed any estimates? And that should be very quick to see. Like, there are no investor days that happen overnight, no conferences. Maybe there was one conference, and you skim through the transcript, nothing material, nothing that hits to any thesis. So, you're no change there. But then you see, the market is choppy. It opens, market goes down like 1%, and you look in your coverage, you notice that like some of your names are down like way more. And you look at like what's happening in those names, and you're like, oh, this doesn't. You then have to make a judgment call. You have to say, does this move make sense on my names? Did anything come out that makes sense for those names to be down that much? And one of the things that you need to know is you also should know like what constitutes a major move. If the stock moves by like 50 basis points, I can almost guarantee that that's not a material move. You need to see it move like 2 times the standard deviation that it normally will move in. That is significant. Okay, you don't want to if it's within 1 standard deviation, then it's really probably not, that's normal. It's just trading within a normal range. You should expect that prices will, trade around a normal range 80% of the time. If you look at like stock price data, it tends to cluster around the central tendencies. So it's more peaky than a normal distribution. So, in that case, you should expect that, okay, 80% of the time, stock is going to trade in a normal range. Even if it's down 1%, it's probably its normal range. So then you have to say, okay, well, maybe it's exceeded that, and then you have to ask yourself, well, why would it exceed that? And that's when you do this workflow, which is like, okay, has any material news come out? Anything in macro that could be associated with this? You might do a quick scrub of like, do a social media search, Reddit hits or Twitter hits, nothing. Okay. Then you look in the options market. Hey, did any like options trade come off, and is that what's driving this? You don't see anything. Then yeah, then you can speculate. Then you could fade it. You have to go through and try to disprove that nothing informational happened, right? And then you also want to have like a theory about like why the price is down. So often the theories around why a price is down is like non price sensitive flow. Okay, so then you have to think like, well, what would cause the non price sensitive flow? What would make a more what would drive that flow? And you might think like, oh, well, you know what? Today market volumes are generally light. Okay, I'm looking at the index, and like the volumes at the index level seem pretty light. And I'm actually seeing that there's like a rebalancing, or it looks like a rebalancing took place, because all of the names that are up in my coverage are the stocks that have been down for the year. All the stocks that are up or that are down today are stocks that have been up for the year. So that seems like it's a rebalancing, either from like a pension, from like a fund investor, or a wealth manager or something along those lines. And so then now you have like a theory about like what you think has happened, and you'd want to then try to prove that theory. So instead of you doing like an equity research workflow, he would do like a more of like a deep dive on who owns the shares, and you might want to look at what happened in prior quarters. This is what we call putting together query tables. Like, I know that I'm opening up a can of worms here because I'm talking about like workflows that we've never spoken about before, but there are many of these like distinct and unique workflows that you will learn over time, and you'll have as part of your toolkit to help you try to figure out like, what's happening here, like what's going on behind the scenes. And then the other thing that you would do too is, you call prime desks, or you call, desks, and you say, hey, like, what's your guys' color? What kind of comments you guys have about flow? Andy, I'm sure, can share more about that because he saw it. It's a very common thing, like for portfolio managers to call up Goldman's prime desk, even if they're not clients, by the way, and just say like, hey, what's happening in this name? Because that's how you might glean some information about, what's happening.
Yeah,
But
at least eliminate some wrong answers, definitely.
Exactly. Yeah, it's never perfect because also like sometimes those guys don't know either, but they just want to pretend that they do.
Right.
But it is helpful. I would say probably the most helpful stuff though is that you see changes in like the borrow rates. That's often like a good sign that like someone is degrossing, so some short is being covered, or vice versa. So there's a lot of these like different things to look for. There's like a million things to potentially look for, and what the thing is, as an analyst, you'll have a limited amount of time and a limited amount of like resources and focus and attention and understanding of how things work. So what you kind of want to do is, and this is going to sound kind of hard, but like this is why I believe that investing is actually a team sport. You have to lean on people that do know. Okay, so you would build rapport with like a sales trader, so that you can ask them those questions, right? Or you talk to your PM and like, do that. It's like virtually impossible for one person to be able to like do this full mosaic analysis of any company at any given time. It's like saying that one person can build a 3 nanometer semiconductor by themselves. It's just not going to happen. You really need, it's really a team effort.
You have like an automatic way of checking for something, such as the momentum or the rebalancing you were describing.
Okay, I'm going to share an extremely important secret here. This is so secret. This is going to like make everyone $1 billion. Joking. There's just a super easy way to like evaluate the momentum. You have a column. So like, how you have a workspace? You have a monitor. In the monitor, you have a column which shows your like 1 year return. Everyone that trades, or every like professional investor that's trading momentum, defines momentum primarily as the 1 year trailing return. So that's the most significant and price sensitive like measure of momentum. Just look at that 1 year return. So if I see that a stock, if I have 5 stocks on my list, I can see who's up the most in the year, right? And so who's if I have 5 stocks on a list and I can see who's up in the year, I then also know who's at the greatest risk of a rebalance. Because if I rebalance, that means that I'm gonna like, what the action in a rebalance ends up selling winners and buying losers. Okay, like that's actually what a rebalance like theoretic like. This is the consequence of a rebalance. Okay, so when people think about rebalancing, they think like, I want to maintain my active weights. I don't want to drift from an active weight that I have set. But the reality is, you end up selling your winners and you end up buying losers to maintain those weights. Okay, so and that part is not explicit. Okay, that's just an implicit aspect of rebalancing. Okay, it's a natural consequence of rebalancing. And so you can see this. So what I do is I'll track like the 1 month return, the 3 month return, and the 1 year return. Or I'll just do like 1 month and 1 year. That's probably the two that you need to pay the most attention to. on a 1 month basis. So if I see a stock that's like up the most on a 1 year basis, then I would expect that in the last 1 month, it probably has underperformed versus the average. Because this is what tends to happen. This is like the heuristic that you can have in mind. Stocks tend to see a short-term reversal over the last 1 month, and they tend to have momentum over the past 1 year. So you can kind of track to that. That's how you can kind of quickly kind of like gauge what you think is happening, like form a hunch. Again, it's not telling you exactly what's happening, but that's like how you can form a hunch. So that's what I would do. Another thing that I look at is like, obviously if there's like an increase in volume. So, what we use is something called like average volume at time. And that tells you like at this time, like is my average above or below, what normally happens. And that's like useful. You don't have to use necessarily AVAT if you don't have it. You can look at just like the today's like the 2-day average volume versus like the last 20-day average volume. That's probably good enough. So those are some things that you can use. That's like the proper technicals to use. Like if you were to say, if I were to, I would call this like, yeah, this is like my technical analysis, right? Because I'm using the price and volume data to understand what's happening. So yeah, that's you look at it in like a tabular format, and it's extremely easy to see. And I can sort, I can filter, I can quickly kind of see what's happening there. Does that answer your question though? Like quickly saying like what stocks are at momentum risk.
Yeah, it does. Thanks. But I suppose you have. Well, yeah, that answers my question. The monitor.
Yeah, let me I'll show you guys like this is so many screens up right now. It's like crazy. Share my typical. This is my monitor that I use. So I'm going to do a subsample. So if I mess around with it, it won't hurt me. Okay, so this thing is my monitor. This is what I like. This is the dashboard that you want to have a dashboard like this. That's what you want to build. Whether you're on, this is it on Bloomberg, but you can do the same thing on Workspace. When you have these tools, it's cool because it's linked, so I can click on the stock and I can immediately like see, other stuff about it, which is helpful because when I look at a name, like I quickly want to see like, do I have a note on the stock? Well, this is like Bloomberg has their own internal noting tool, and I'm starting to use that again. So right now, a lot of the stuff is pretty stale, but it's going to be how I'm going to run my RMS. But you can have notes. You can see like the recent filings. You can see my peer comps, and then this is a price chart with earnings and like key news. Because like sometimes if I'm looking at this, I'm gonna be like, when was their product release? And so this is like an easy way for me to like find the date really quickly. This is their valuation. This is the estimate revision, or these are the estimates, right? But this is the monitor, and I would say that you don't even need anything else. Like if you just have this, you're pretty much good to go. And so I think I've walked through this with you guys before, but it's like I got my tickers, I organize them by my verticals, okay, and these are custom columns that I have created. But the actual things that I pay attention to is I got like, okay, my 1 day, my year to date, and then my percentage return from 52-week high. So you see over here, I don't even have like my 1 years or my 1 months, up. Like this is pretty much like fine to evaluate the same sort of thing. So if a stock is like high up year to date, we're far enough in the year that this is useful. When we're at the beginning of the year, I'll make this back to 1 year, but we're far enough in the year. And then 52-week high is just like over a year, and so I can see like, okay, well, who's down a ton, right? Who's down through the year, and then yeah, that tells me, okay, if I think that the stock is going to have some, reversal risk. These are the these are the surprise data. So sales surprise and EPS surprise from their last reported date. This is an important column to have. And then I have their estimate revisions here, so I can kind of quickly see those revisions. And these are like the valuation ranges. So this is the other thing that's like super helpful. If I see a name like this where, the stock is, it's trading at the high end of a range. Okay, now I'm like, oh, like what's happening there? Well, I know what happened because IBM reported. I was, I'm long IBM. I know what the thesis is, so this is not a concern. But if this was, just every day I'm gonna, when I'm looking through like, okay, what's going on with my coverage, I'm going through these, and I'm gonna want to see like, if I see something out of whack, this is how I can see like if it's like a, standard deviation sort of a move. Then I've got my delta AVAT, so this is like my, how volume looks like relative to what it is over the past 20 days. Short interest as a percentage of equity float. Oh, does it surprise you that you have companies that are seeing really big, impact or big move in stock price? They also have really high, short interest, right? And you could ask yourself, okay, I know that. Well, let's talk about Fastly, Akamai, and Cloudflare. These are like your CDNs. Okay, so in this environment, you can kind of see like, oh, well, who is long? Where's the market long and where's the market short? Looks like everyone is short Fastly, and people are probably a little long, in Akamai. And there's a lot of criticism for Fastly, but you can kind of like see that, already. Yeah, this is pretty much like a basic, overview that I recommend, having. And you can add in more detail too. So this is like, by all means, this is not like everything, but this is like a good starting point. So whenever, whenever you guys are talking about a stock, like I just look at this really quickly and I'm like, okay, this kind of tells me, what I need to know. Now, in my portfolio manager spreadsheet, then I take it to the next level and I run a lot more analytics there. Let me actually show you guys what my PM sheet looks like. Okay, so I'm gonna hide a portion of it. I want to show you guys like how I'm like evaluating certain risk parameters, because I think it's useful to see. Trying to find my, okay, here we go. Okay, so this is like an example of how I track my factor risks. Okay, so I want you guys to kind of see how this works. This is my actual portfolio, manager spreadsheet. Okay, just so that you guys can understand this. And I do it, the top part is all longs, and then the bottom I do the same thing on the short side. Okay, so constantly the same. And so over here, I track the earnings date. I use a little indicator to say, yeah, it's kind of super nested, formulas, but it's like, just am I going to report today or tomorrow or whatever? So this helps me kind of track it. I track the prices at certain dates. So because I want to know like what my month to date performance is. And I track what's called short-term risk. I track a squeeze risk. And then if some of these get really out of whack, then this will trigger a little, alert for me to pay more attention. But these are already kind of giving me a sense as to like what I need to review or pay attention to. Then I've got my factor risk exposures. This is how you manage factor risk, by the way. So you see over here, I've selected various factors that I'm evaluating myself to. This is what I do in my own spreadsheet. So like obviously, I have my statements and I can run them through software that can analyze them too. But this is what I actually run in my own spreadsheet, so I can track this in the moment, in real time. Okay, that's very hard to do, generally speaking. So what this means is there are a couple of these indices that I track. So revisions, estimates. Goldman Sachs has high beta momentum. That's like how I used to track my momentum risk exposure. This is momentum, but short momentum. This is the crowding indicator, the Goldman Sachs VIP list. Quality, value, and then cloud, cyber, semis, and AI. Okay. And then I could see that these are my factor in beta dollars as a percentage of my total asset value. So I can sum these values up and I can see what my gross exposure is to that factor. And I can add it to my short exposure to those factor, and I can see what my net exposure ultimately to that factor is. That's super, super important. Okay. And that is
sorry, are you using, are these numbers here, these like 1.20, is that a correlation to the index?
These are betas. These are the betas.
That's the beta of the
stock to that factor or to that index. Yes.
Okay.
Yeah.
Thanks.
And you can do this in, now that I actually have the workspace license, I can put this into workspace and you could probably run the same variables to see this. But this is how you can then roll this up to track to see what your exposures are, and then you manage the risk. If you look and you see, oh, you know what, I'm super exposed to like high beta momentum, then you know that you need to trim those positions, and you'll know where you can trim those positions. Or you might say, I need to add more long, or I need to add more shorts to like reduce that exposure. But it just like gives you the a game plan of like how to actually respond to this. So this is the stuff that like, if there's like a PM at another shop and they're watching this video and they see this, I'm sure they're like, tears in the eyes, because they know like how important these sort of things are and how hard it is to like to have a setup that actually works. And then let me see if I can show you guys like what the on a rolled up basis, it can look like. Okay, I'm going to show you guys additional. This is how I roll it up to actually just like see exactly what my positioning looks like. I had to move a few things around, so apologize for that. But really don't want to have my positions displayed publicly right now. Okay, there we go. I just whited stuff out, so hopefully that works. Okay, so this is an example of like a exposure report. you know, and I actually create a separate report tab for that I send out to you know, my like fund admins and to you know, a couple of, you know, my anchors and so on and so forth. So they get a daily report that makes this look all pretty. But I just want to walk you guys through exactly how this works. So over here, you know, you can see my exposures. So right now I've have no macro or sector bet that I've put on right now. My gross exposure, I see what my gross exposures are. I see what my exposures per industry verticals are. So I got software, hardware, and internet, because these are like the individual trades that I'm making, right? So the individual names that I'm investing in. So you get my net exposure from that, you know. So I'm running at around, you know, 13.8%. Now my gross is fairly light though. Like I'm only at 110 gross. This is pretty low. Typically a low gross would be around 150. So I'm at 110. So that's it's quite low. And then if you see my industry, this gives you like a further breakdown because I look at my verticals. So these are my industry groups. So within each sector, I look at my industry groups, and you can see like how I'm, you know, invested kind of across the space. So my biggest exposure comes from, you know, software, and then my lowest exposure comes from hardware. But that's probably where I have the most amount of, well, second most amount of names, but just my net is much tighter. And then you can see my factor exposures here laid out. So like my exposure to revisions is 16%. My exposure to high beta momentum is 11%. My exposure to crowding is 7%. I try to keep these under 20%. Okay, and if I were more market neutral, these would be close to zero, and maybe I could tilt up to like 5 to 8% if I was true market neutral. But given that I have a net exposure, you know, I have that kind of a mandate, you know. So in that case, I do want to have some net. And then if you think about my strategy, what is my strategy? Well, I'm a tech strategy. Okay, so I'm a tech investor. And then what do you guys know about fundamentals? Like at the end of the day, I want to be long stocks that are seeing positive revisions, and I want to be. I mean, that should be ex post what my portfolio looks like, right? It should track those, and that's what, you know. And so I can say that, yeah, like my portfolio is the most long, or I've got the most exposure to revisions, and that's okay, because if I were to have a factor tilt, that's the quote unquote fundamental equity factor tilt. Okay, revisions.
How are you measuring revisions here?
Revisions.
Yeah.
Bloomberg has an index which measures the change, you know, companies that have like a change in revisions. And so I measure my exposures. You know, in the other sheet that I showed you guys, I measured my exposures to all of these factors by multiplying the stock by the beta to that factor. Okay, so what that should tell you is that, like, I'm most long companies that have those you know, positive revisions. So that's kind of how, you know, how this works. In one thing that I want to point out here is you'll notice that my semis exposure looks really negative, but it doesn't seem negative up over here. So like, what's actually happening? Well, why this looks negative is because the way I'm pretty much short like cyclical semiconductors, but I'm long like AI beneficiary semiconductors. So it's really like these two that are, you know, interplaying. So, you know, that negative, you know, revision, or that negative exposure is not really not truly a negative. Yeah, this is how this stuff. This is how you want to track your exposures. And look at these. You know, one of the things that I actually do is, you know, so investors always want to, you know, especially if you're looking at professional investors, they want to see these sheets. And so when I, like, you know, send my stuff out to you know, pension funds, or like institutional investors, or rather investment consultants who will like advise, you know, institutional investors, I actually send them this portfolio sheet. So every month I create a new portfolio sheet, and you can see every portfolio sheet that I've created right since I've started, managing, money, and you can just see like, okay, my positions. You can see like how I've managed risk, and that's really important for like tracking at the PM level. I would say for you guys as analysts, what you really want to focus on is getting better at the coverage process. But once you as you start maybe putting on some of your own ideas, right, you may want to start thinking about, how you, or how you are tracking to those, to those things as well.
Our tracking is really, really similar in some respects, except the exposures I'm tracking are thematic, like we were talking earlier this week about themes. And I don't have Bloomberg, so I don't have the nice GS roll up, of like momentum or the different factors that you had in your sheet. I don't have those at all. Just because I don't have the data. I'm not currently shelling out for Bloomberg. But I do have them by theme, and I have all of the long short weightings and net exposure and all the my sheet looks really, really similar, but like sans the other factor weightings that you were showing. The betas, I don't have those.
Yes, that's good. And I would say like the thing is, I didn't build this all by myself. I'm really I've, my partner, I leveraged a lot of how him and his fund used to run risk exposures, and then I've had multiple calls and meetings with people that are like specialists in risk management, and would have them like review like my formulas even, or I like walk them through like, this is how I'm doing this spreadsheet, like, am I doing this right? And that's really important. Like I said, investing is really a team sport. You cannot build, just like you can't build a 3-node semiconductor by yourself. It's extremely hard to build the full stack of portfolio management and coverage, by yourself. So definitely leverage, the expertise of other people, that you trust or that and use that to help you, build, and improve your process, because it's extremely hard. And also, one of the other things too is like, there's nothing that's like off the shelf that works really well. I've seen like the cutting edge risk management software that's out there, and it just doesn't work as well at like my clunky spreadsheet that you guys saw. I mean, is like 5 times better. I don't want to say 10 times, but it's like 5 times better than maybe what you'd get if you were using like Aladdin or something like that. What you'd pay like 30 grand a year for.
Yeah.
Maybe.
Yeah, I kind of agree with like, I mean, I have less exposure to, I'm sure, a lot of the commercial tools, but like being a developer, I have great control. I mean, spreadsheets for better or for worse, but like I actually have my valuation models, pricing models. I have real-time Greeks and all that I coded in the back. Instead of Excel, I'm using Google Sheets over here just because they have the app scripts back end, and I kind of can tie into kind of the rest of the Google Cloud ecosystem with it. So, I have mixed feelings about having such things up in the cloud where, theoretically maybe someone at Google could see them, but yeah, like I have tie into the brokerage interfaces and everything like in the back end of Google Sheets. So I get really good real-time analytics. And I didn't see in your sheet, but one thing I do have also is like I guess it's because I'm an options wonk and I come from that school, but I always take a lens to like Greek exposures to the whole portfolio, right? And then break them down, and I used to have, exotics in there that I didn't really use, which I shit can't, but I happen to agree that like there's nothing off the shelf that I've ever found that asterisks that I could afford. Maybe there's something great that I can't afford. I don't know.
Well, what I'm saying is that even the stuff that like institutional investors use are just like not that great. Like they struggle. There's a lot of problems too that happens because you run into like multidimensionality issues, like what happens when you have like two factors interacting with each other, right? Like you run into like a whole host of problems, and this complicates things for a PM. And so one of the things I like about like how I've approached this is it's really focused on getting it down to like, I just need to understand at the end of the day, I need to know like what's my net exposure to these factors so I can make a decision on what to do about them, right? So I need to track those exposures and do that. On the Greek side, I have a separate panel that I use for options, and I do track the option weighting and how all those fit in. If I put an option position on, I want to see how it impacts my factor risk exposures too. And so what that means is if I put an option position in, I'm going to plug in the underlying, and I'm going to calculate the betas times the delta times the the notional, right? And so that way I'm actually coming up with the like beta adjusted impact of having an additional option position on. Calculating those things is extremely valuable because there's just not a lot of software that does it on a beta adjusted basis. The best tools that I've seen still do it just on like a delta adjusted basis, but because we are like active, we're pretty active, higher frequency traders. We need to be able to understand what's happening on a beta adjusted basis because betas can move a lot, in a 6-month period. And so if you're stuck using just like Delta, Delta doesn't tell you enough because I could have a stock, I could put $1,000 in the stock, but it could have like a 4 beta, right? So that means that my price moves are just so much more. The Delta positions really tell you about, the volatility and my actual kind of risk exposure. So really important to have the beta adjusted, aspects too.
Yeah, and everything I run is beta adjusted, by the way. And I've also found like the broker tools are a little dubious. Like I don't trust them, because like IBs, for example, portfolio analytics can be a little dubious. Certainly like the other retail tools like TD, or which is now Schwab. You actually TD's beta weighting calculations tend to be a little more reliable, but I still do them. I still extract the data manually, do them in sheet because I just don't trust anyone. Maybe I shouldn't trust myself with that, but I don't trust anyone with it. And I've been burned, like specifically burned by the IB tool a long time ago.
Yeah, IB's tool is not that great.
Do you find the institutions who are looking at you, are they looking for something standard also? Like, are they looking for VAR or CVAR type risk analytics from you?
Yeah, so I'll generate like my VAR, my daily VAR. There's them that I look at, and it's so it's important to understand how like funding works. But the more leverage that you use in a portfolio, the more you need to track, right, your daily VAR. And pretty much no one wants you to have a daily VAR where you could lose like 2% in a day. So you really have to like manage your risk within a very specific window. It's kind of like there's a sandbox, and the sandbox is you need to be roughly factor neutral or like have a defined factor exposure. 10 to 20% is fine, but like set a defined factor exposure, set a defined maximum net exposure, and then limit your VAR to like 80 basis points or something like that. Your daily VAR to 80 basis points, and then from there, you can get an allocation of capital. But the allocators sometimes, they're grossed up already. And so you don't know where the source of your funds is coming from. And so even if, that makes it really important to make sure that you're operating within that parameter. And because of that, yeah, there is a little bit of a standard, which is like, you have to know what your VAR is. You have to know what the standard deviation of your portfolio is. If you have a high standard deviation portfolio, you're really not going to be attractive to like your most professional investment allocators. If you have they're really going to look for managers that have a good realized Sharpe ratio, where you can like generate, what matters to them more is like, so like, I'm gonna give you an example of like what skill is CNETs. So you can have like imagine like a basketball player or like a sports player. You can have a sports player that like, you know, is sometimes they do really well, and then sometimes they choke, right? Sometimes they don't do well. That type of athlete is just not very popular for professional investors. What they really want to see are athletes that are consistent. So like at the PM level, you really need to show like consistency in your P&L. If you can just do like, if you can make a positive P&L, 9 months out of the year and limit your downside to like 80 basis points when it goes against you. I like that. I have a higher net, so like that, that blows me out too. But we just have to be realistic that like that's the actual, that's what investors really want. And so then you have to understand, okay, well, my strategy is not market neutral, so then you can multiply that by your net exposure. Okay, if my net exposure is actually going to be like, larger, then do I fit the same parameter given my higher net? Now, as long as you fit the parameter with your higher net, then it works out. But if you're like if you're a market neutral trader and you're running at like a pretty high realized vol, that's something that is definitely going to be, that's where you're going to see like concerns from the institutional side.
That's interesting because, really interesting because like, so for one thing over here right now, at least, I run, whether I'm market neutral or not, depends on my view on, primarily macro factors, right? And whether I'm biased long or short, is also guided by that. But the other thing it's guided by is like I pay pretty close attention to both implied and realized correlation as extracted from strips of at the money, right? Like in the CBOE fashion, right? Because if you're market neutral, and you're realizing like uh, very low correlation, right? There's a difference in that dispersion, than when you're realizing high correlation. And you kind of have to be sensitive, like you have to be positioned and sensitive to what your forecast of realized correlation is going to be, especially if you're like me and you're swinging your bias around, So I also pay attention to it vis-a-vis risk and like how much gross exposure I want to have in aggregate is dependent not only, I mean, in general, like correlation and volatility go up and down, they are correlated, they go up and down together, right? But there are regimes, right, where like last year, implied correlation tended to be drifting tended to be in the 30s, right? Whether, vol is bouncing up and down all over the place, but it was kind of staying pegged in the 30s. This year, implied correlation, like last month, I hit an all-time low. I hit like 8, which had never been seen before, right? And was kind of a question mark for me. That's no longer the case now. Obviously, the vol has come up. And you're seeing these kind of weird effect, like dampening effects too. By the way, I think there's like so much. I mean, we were getting off topic here, but there's so much like systematic short vol now. There seems to be like a dampening effect in these whenever there's not a shock, but like on a given day, and it seems like vol and correlation just keep getting crushed lower and lower and lower and lower, asymptotically to zero. That's got to be this. It's got to be all these short vol, systematic short vol funds and ETFs now. They're just like passive, just sell the strip, sell the strip, sell the strip. But you don't find you don't track sensitivity to factors like that, right?
So like implied correlations.
Yeah, like implied correlation, for example, as a measure of risk.
Yeah, those I'll look at those at like part of like just like a broader, macro toolkit. But it, it's like even like the VIX, like, I'm not regressing my portfolio against the VIX because my strategy is fundamental long short equity. So I want to, I'm gonna choose. I can't be. I mean, there's like a factors view of like 400 plus factors out there, right? So it's like it would be like almost impossible to like be truly, factor neutral in all senses. But you kind of have to pick like, okay, for the strategy that I'm running, what are the risks that I need to manage for that tend to be like the biggest risks, and then do my best to like track and manage those. And if it's, if I'm running an equity strategy, then I need to be paying the closest attention to equity factor risk, not interest rate factor risk or currency factor risk. Like that should have like a negligible impact on my portfolio. Every other sort of risk should be less than like I should expect that my net exposure to those are like say less than 2%. And so that's like the general goal, but you have to really pick the kind of factors that you're gonna play with and then run from there. So it depends on the strategy. I mean, I think sounds like you're run more of like a vol book sort of a thing. So that I think is just like a different type of strategy.
Well, it's just I guess it's just that I'm usually all option structure, right? So, and I come from trying to run complex yet useless books like Dispersion. Back in the day, right? So I guess I come with that lens to it, but I'm trying to get where you are, as a purist.
I think the most important thing is like being very focused on where you're going to try to find edge and running the portfolio based upon that, right? So it's like if you think that you're going to get edge from from the vol side, then you want to be a vol trader. If you're just using options to structure a delta trade, then you want to use equity factors. At the end of the day, you're an equity trader. You're just using options to price the trades. I have that laid out. So if you kind of want to see how I've done it, I'm happy to share that that part of my spreadsheet with you, and you can kind of play around with it. But I would say at the end of the day, like if you have like a butterfly, for example, on the trade desk, at the end of the day, you have a delta exposure to the trade desk, right? And you want to see like what your beta adjusted delta exposure is to the trade desk, given the butterfly structure, right? At today's price, right? And so obviously the delta is going to shift from today to tomorrow. And if tomorrow it swings your net exposure, outside of a limit, then you need to think about how you're going to respond to that. And when you are thinking about adding a position to the portfolio, you should think about how will this position impact my factor exposures. Like I'll look at, okay, well, if I, the way that you should try to understand all of these exposures is that at the end of the day, you just want to isolate the part that you're going to get paid on, right? So like, yeah, I mean, if I have a view, if I'm like, what, I think that gold is going to go up by 50%. It's going to go to $2,500 or whatever by next Friday. Okay, next Friday is the catalyst, or Thursday is the catalyst. I think that what's going to happen is all of the inflation is going to come in super hot, and that's going to push gold prices up like crazy. That's my view. Whether I'm right or wrong, and my analytical process, is good or bad, is a whole different story. But now I have the trade, right? Okay, I want to go long this. So, what I want to do is I will put the trade on now, right? And I want to have some exposure. Okay. So what exposure do I want to have? Well, do I want to have exposure to gold? Yes, I want to have exposure to gold. Do I want to have exposure to all of the other precious metals? No. This is an idio gold trade. So what am I going to do here? I'll probably short silver, or I'll short platinum or palladium or whatever. Okay. Now, what's my risk limit on my net exposure? I set a limit, which is that the maximum net exposure I can have is 8%. So that means that the maximum size of my beta adjusted position in gold is going to be 8%. Okay, so that's the weight of gold in my portfolio, and then my net exposure my total portfolio's net exposure, maybe I'm targeting, 10%. So if I max my 8% weight in gold and I'm shorting 5% of say silver, then the balance is a 3% net, right? So like I know the risk that I'm running. And so the idea is that I'm really trying to monetize that idio reaction. There's going to be some move in price that is idiosyncratic that I want to capture. I don't want to capture anything else. So to some degree, and this is the way that I see it. I actually kind of prefer when I put on a trade if like, I don't want to say it moves against me, but if like, yeah, I want to see like my portfolio should be flat. Like I should not make any money on a day where I don't have any monetization catalysts driving it. Like so, like I'm very happy when I have a flat day. Like if I could have a flat day every single day, except for days that I'm taking specific idio risk on, that would be like the goal. Now, obviously, you're going to have some sort of a carry, and carry is risk premia that you want to have exposure to, and the risk premia that we want to have as equity guys or people that we want to have exposure to is the revision anomaly. So we will typically be a little long revisions, right? So our net exposure to revision should be, positive, maybe like, plus 10 or plus 20. And so in that scenario, we would expect that we do get a little bit of a move based upon how revisions perform, because we want that positive carry. So if you have like every day, on average, you'll accrete 5 basis points because of that, revision carry, and then you can get like an occasional 50% or 50 basis point or 100 basis point move because of your idio trades. That's ideal. That would be like the ideal structure. And ideally, you have these like laid out where they don't all cluster around one period. One of the things that I've noticed in my performance is that they do tend to cluster around earnings. So like my P&L looks a little bit like kind of like a step function where like after major earnings catalysts, you get a big move up, and then there's a plateau, and then the next move up, from earnings. So as long as I'm like net positive on earnings, you get that step up, and that tends to be like how things work. And then ideally, like then, if I could smooth that out over time, that would be better. But I think that's okay. That's kind of like how it should be if you're idio and catalyst focused,
So when you said exposure limit of 8%, is that a net or a gross?
That's a percentage of NAV on a beta adjusted basis.
Percentage of NAV.
Yeah. And then delta max is 10%. Because sometimes if my beta is like 0.8, right, if I buy, I can buy a cash delta of 10% to get me to an 8% beta adjusted weight. So that's why you have both the limit on the delta and on the cash delta, and also on beta weights.
So you would have, and of course you're not always taking 8%, right? You take smaller than that too.
Right.
So that would put you in the neighborhood. So is your gross target like 2 to 1?
What do you mean?
Is that in terms of leverage? Sorry.
Oh, I mean, gross is going to be, it depends. Like typically I'm going to run the book. You can say like on average, I'll run the book between like 200 to 300 gross. And if you think about that, 200 gross is if I'm like market neutral. 100% long, 100% short.
Yeah.
Okay, that roughly gets into 200 gross. If you get below 200 gross, so you're like 150, then that means that my net exposure is up or down. I could have a positive net exposure or a negative net exposure. If I move above 200 gross, then that is typically a flatter book in bigger size. So like I'm probably running at like a small net exposure of like say 5%. And so at a 5% net, I can gross up, on that, and there's not a lot to risk there. Typically, the higher the net, the lower the gross, and vice versa. So if my net is at 40, I'm going to be like well below 200. If my net is at 5, I'm going to be closer to like 250. Okay, so the amount of gross you take, and the way that you should see gross is kind of like a leverage, right? A measure of leverage.
That's the way I look at it.
Yeah, if you have a high net and a high gross, then you're just going to blow up. So you have to, you have to, and then so the limiting scalar is your value at risk. So every day you want to run a value at risk report, and you want to see how much could I, given my positioning, how much can I lose? What percentage of my portfolio could I lose? And we have, we typically we track like the hard. I don't want to call it a hard stop, but we have like a hard stop at 2%. So like
for VAR,
on VAR, yeah. So like if we hit a 2% down day, then that means that like we're probably liquidating, half our book, because something must be really going wrong. But on average,
I run way hotter than you.
but on average, we're gonna look at a VAR closer to like 80 basis points, and the right way to understand VAR is that VAR isn't looking at your IDEO. Okay, like I have a trade tomorrow that's going to print me 20%.
Yeah.
But I want to know like what's my average value at risk given like my positions. That shouldn't be 20%. That should be like 1%. And then because then it makes sense that I'm generating an IDEO 20%. But if I'm running my VAR at 20%, then that's just going to be low risk. So you pretty much want to have like thresholds for VAR. So like a good threshold would be like daily 1%. Like don't have a portfolio where you could on a normal day, pretty much on a 3 standard deviation day, lose more than 1%. Like that's not a good thing. Or if you have that 1%, then that should tell you that you should trim you need to degross your book. If it goes down by 2 times that amount, then you need to like substantially degross. Like that's what it's telling you to do. And so if you are already at the point where if I run my VAR today and my VAR is at, say I'm grossed up, 400%, and my VAR is at 80 basis points, well, I have a lot of, that's safe. If I have an IDEO event, so say tomorrow, I'm grossed up on all these positions, but I'm managing my risk well so that my VAR is quite low. But tomorrow I have earnings, and my earnings blow out. CrowdStrike goes down 50%, and then I lose money. That is that's acceptable. So what it really boils down to is like why people pay attention to like VAR and exposure and so on and so forth. It's because you want to go to an investor, you want to say, hey, look, I'm not always going to make money. I'm going to lose money plenty of times too. But when I lose money, it's going to be because I'm taking active risk. I'm not going to lose money randomly.
Right.
Okay?
Yeah.
That's the key thing. And so that's why you want it. That's why you set those VAR limits. Obviously, they don't incorporate the IDEO component to your risk. So you're going to blow out a VAR from IDEO.
Yeah.
And that's okay. But you don't want to blow out a VAR on non-IDEO. That means that you are just badly positioned. Your gross is probably too high. You're not managing, your book well. So that's the way that it is. No one is going to blame you for missing swings when you took a swing. Okay, but if your fire gets burnt, right, and because I don't know, if you don't take a swing and you're getting blown up, then that's a really, really bad sign, right? No one wants to invest with that.
Yeah, no, that makes a ton of sense. Thanks for that. Thanks for walking through that because, yeah, I would say like I'm definitely running hotter than that, just because I'm a 4-1 or 5-1, but my modeling. I had some open questions. And the other thing I look at is like maximum adverse, like stress testing, basically maximum adverse, maximum favorable, like in the tails, just to understand what it is. Do you Do you have like absolute risk limits for tails?
So there's a whole. This is when we're getting into like really like niche debates, and there's a lot of debate about like how should you manage risk. You know, from a tail standpoint, like should you manage the distribution of risk? Should you manage like the tails of risk? It depends on the strategy. And a long short equity book where my focus is on IDEO, then I'm trying to make money off the tails. I'm taking active risk on the tails. So I need to actually manage my distribution. If you are trading the distribution, right, then you need to have the opposite. You need to be managing risk on the tails. So that's the difference. For the type of book that I run or the strategy that I run, I actually want the exposure to tails. That's active risk that I'm taking. And if you guys don't, just to kind of like explain what that means is like, if you take like a distribution of returns and you just plot it, I'm not investing in a stock because I think it's going to go up 2%. I'm investing in a 2% stock, but I think it's going to go up 20%. That's a really far right tail event. But you know what? The stock could miss and it could be down 40%. That's the active risk that I want to take. What I don't want to take is just the daily 2% gain, because that is beta. So when you're, at least in equities, and you're trying to focus on IDEOs, you are taking active risk on the tails. And so you need to minimize the distribution in the center. Right? If you can get that really low, then that's what matters. If you skew the book so that way you can reduce your left tail risk, you could try doing that too. I think generally speaking, the risk management strategies of like degrossing and having like that risk and that exposure limits, those are all designed to limit that left tail risk already. So I kind of think that it would be redundant to, like, there's no reason, like, I wouldn't just buy puts in the book because I wanted to reduce my left tail risk. Like, I just wouldn't do that because I'm already doing that effectively by having exposure limits and bar limits and so on and so forth. So the only time I would buy puts is if I actively had a view that something was going to go down in price.
Yeah. And that's, I'm always trying to hedge that left tail because I've been alive through too many market cycles, I guess. And, you can consider it an overlay because, I also monetize the tail, right? So it's not like a passive put hedge, like, if I'm trading it in response to whatever's happening, right? So if it, like, last week when vol climbs up, I sell the natural puts and then I get long additional vertical put structure. I monetize that as well. So in that second 3% down day, right, I monetize again, right? And I'm kind of like keeping, I guess it's really hard to describe, I guess, if without a chart in front of us to kind of talk about, but like, re-anchoring, if you will, to a specific point, like to a specific strike that is a function of current volatility versus the price that I'm willing to pay, to maintain the tail hedge on an annualized basis, right? So that's the way I look at it, is like whatever my current exposure is, whatever my current net exposure is, I try to hedge the tail risk in that net. And then otherwise I'm doing everything else that you suggest. So like I'm keeping strict, both thematic, like risk limits, like thematic betas, if you will, as well as traditional sector and industry risk limits, as well as most of the risk that I put on has defined risk, so it's an option structure that defined risk. And yeah, so that in my case, in all those structures anyway, like the left tail is hedged, absolutely in an individual name. But that doesn't stop, correlated bad luck, from happening from time to time in the left tail anyway, right? Those just stop, right? But I guess, one of my takeaways from this conversation is like I'm running way hotter than, and I was looking at, net versus gross position limits quite differently. Yeah, so that's an interesting takeaway for me is that you're kind of capping things at 8% of NAV.
Yeah, I mean, there's definitely room for investors that have very concentrated portfolios. I met with MIT's endowment, and they actually, the guy was like, "Hey, I like it. I like your style, but right now in our mandate, we're looking for like long only investors that just have like 10 positions, and 100% net, and so I was like, hey, can we do something? And they were like, we just don't they don't like the short part, but so there's definitely room for all sorts of strategies. I don't want to make a claim that any one strategy is better than another, or that there is an appetite for any sort of strategy, but it's just a matter of like, for the strategy that you're running, it's really important to do your attribution analysis to really understand what's driving your returns, and then to make sure that you're managing risk, effectively to that. So like for a long short style, like mine, it's where, I really want to focus on the tail events. I'm searching for idio tail events. And so that means that I need to limit the belly, and reduce the exposure to the distribution, and focus my time and energy on those tail outcomes. But at the end of the day, because I'm running an equity portfolio, I'm managing my risk to equity factors. That's like a key thing.
Yeah. Now that makes a lot of sense. Thank you so much for sharing that.
Yeah, it's
you make me better every day, Wahdy.
I mean, you bring a lot of wisdom from just like the market's background. So I mean, this is definitely a two-way street. I think I would say that, and this is a caveat to like the style and everything that I say, which is that I'm like hyper influenced by pod shop styles, so like Millennium or Citadel, or managers that run this style. And so because that's my frame of reference, that's what I'm going to think about when I put together these risk tools. It's not the only way, and so I for anyone that's like watching, or the rest of us, you don't have to be limited by what I'm saying is what I've seen. It's just one way of doing it. It's how I do it, but it doesn't mean that that's the only way to do it. I think the more important takeaway, and this is like what you do, is you manage you look at your risk, you know what your risk is, and that's what matters. And it's like, right, if you're running your own money, and so this is another thing too. Okay, so I went through a period where I was on an extended garden leave, and I just had like my own capital, and yeah, I ran risk much hotter, and you could generate far more returns. But the thing is that, like, I'm not going to show, I'm generally long, I'm generally doing the same stuff. So I'm still generally like long short, except maybe I'm like swinging it with options, right? And it's like, I can't take that to, Millennium and say, hey guys, like, invest with me. Like, that's not serious, right? So the thing at the end of the day is just really understand, we always need to know, like, we need to be focused on where do we actually drive edge or create edge. And then we need to just like, build workflows, strategies that capture that edge. And the risk management part, that's extremely important too. But I would say that like, that should be designed around your process of edge creation in the first place. So like, if you're finding edge in what you're doing, then your risk management process should really complement your style. So that's a key thing, because especially you're running more of like an options book. Equity factor attribution might not be the most appropriate, right? You might, or maybe you're not just running that, but you also need to run your factor attribution to Greeks. You know, like what's your average like vega, for example, or you know, how does charm impact your portfolio? You know, so on and so forth.
Yeah, and I do have, you know, dollar weighted Greeks, you know, exposure limits as well. That I look at as a, you know, as ratio to NAV. And that's whenever I'm putting something on, I mean that's what I'm looking at, right? And so like that, you know, the trade we were talking about yesterday, the little fly trade and TTD, you know, I'm looking at what my gross exposure limit is, and then, you know, coming up with a dollar delta value, you know, from the spread, and then, you know, depending on the spread, how that exposure changes, you know, through as price changes or as volatility changes, right, or as time changes, and just making sure that it's within those limits, right? And although on a trade like that, it's so small, you know, like that. The further out of the money it is, the smaller I am. I'll put it that way, you know, in terms of exposure. So, okay, it was very helpful for me. I don't know about the rest of you guys, but it was very helpful for me.
So one of the things that you know, that we do is we do these you know, you want to do like a quarterly review, you know, internally, where you look at, you know, how you perform, you know, you look at your attributions and your performance, but you also like compare it, and you compare it to like, well, what if I just bought and hold through the period, like, because you want to learn from like your trading too. One of the like there's a like a common known thing, which is that over trading is like a huge like red flag, right? Because that's where a lot of mistakes are made. And so one of the things that I feel like I have definitely learned through my career is teaching yourself to like sit on your hands is really, really hard, but if you have conviction in your views, that's exactly what you need to like get used to doing, right? You have to like set the board, sit on your hands, wait for the payoff, whether it's right or wrong, right? And then move on. And then you can start to tweak around that, because maybe you can get like a leading indicator that you are wrong, right? But you know, you still need to adjust for that. And I'll give you guys some examples of this, because you know, some of it is still, it's always a learning process, right? You're just never going to get it 100%. And you know, I say that for myself, like, you know, it's very hard. It's not easy. This is extremely tough to consistently do, you know, through time. But like one of the things, for example, that, and this is why, again, like having partners on the team is super helpful. So like, you know, I'll talk to my partner and I'll say like, or I'll tell them of a trade and I'll be like, oh yeah, like, okay, so I give them an update of like earnings, right? And I'm like, oh, you know, this is like, oh, the press release came out and, you know, maybe my thesis is broken, you know, and I'm like tempted to like exit the position, you know, and, you know, he'll say, well, you know, wait for the call. And I know that in the back of my mind that like, that's what I should do. I should wait for the call. But if it was by myself, if I didn't have a reinforcement mechanism, then I might for sure respond, you know, and you know, trade emotionally. So it's really, really key. I would say that, you know, probably one of the most important things I think anyone could do when they're getting into the game is you know, have people that you can, you know, I would say like partner level people, or like say advisor class people who you could like be open and honest with, like, hey, you know, I'm in this like bad, you know, trade, and you know, maybe I had a weak thesis going in and it's just breaking, and now I'm like sitting out like a massive loss, right? Like you need someone who can kind of push back against like the voices in your head and help you stay, you know, on track with your, you know, commitments, you know, hold you accountable. That's extremely, extremely important. I'm not even sure if it's like I'm sure it's like theoretically possible, but you know, this is something where like you have to have people that you can talk to.
Excuse me.
So highly recommend everyone, you know, does that. I for sure, there have been times where like I have made mistakes. There was one time there was a stock. This is a story that actually happened earlier this year. I was short a company. The stock was moving in my favor. But the beta was dropping. So I was at like my max delta weight, that I could have on the position. And I was a little lazy to trim. Okay. So I was letting it hit to 10%, and then I was reducing, my size. So because that's a short position, works in your favor, it becomes a smaller, size in your portfolio. So it's like, it just kind of like worked for me, in that sense. And then what happened was there was a rumor that stock was going to get acquired, and it shot up like 26% in one day. And I panicked so much that I swept screens. I filled half my position. Like I covered half my position. I was so scared. Like I was seriously panicking. Like I was like, it was one of those things where it was like, it's not that I was past my limit. No, it was within a 10%, range. Like it was fine. But nonetheless, when you see something move against you that quickly, it's extremely frightening. And this happened like right after close. Like it was like 2 minutes after close. So I'm like, my transaction costs were like dollar wide, I'm sure. Like it was just disgusting. Okay. So I covered half my position, because I was so worried that this was gonna, metastasize into something. And by open, stock was like roughly flat. Okay. So this rumor, like I might have been like the only volume like at that time, I mean, there was more volume, but like I was a significant, I was all the flow there. And it was one of those things where I was just like, wow, that was like really, really, really stupid of me. I had reason to be. It's not that I didn't have a reason, right? It's just that the thing was I let that fear of something like really material and terrible overcome a more like say like a more prudent approach. And like the prudent approach was, so every time the stock is going down, so say I'm like short at 10% of my weight, right? I'm short 10%, and then like stock continues to fall, so my weight goes from 10% to 8%, and I would just keep re-upping. Okay, so now the size, like the units of shares that I held had become like a decent amount. Okay, it was now like a significant amount, and that was the risk that I had taken. And it wasn't until like I was telling, I was talking to my business partner, I was like, hey, like this is what happened. I felt like an idiot. It was like, yeah, you were a little bit of an idiot. I understand why you did it. But he was like, the risk here is that, you kept building, you kept adding to this position as the stock was declining. And you need to have you need to think about that like you had crossed over a threshold of what your participation would look like if you needed to sweep. That was the risk that you had. It wasn't, you were within your VAR, you were within your net exposure, right? But you actually got to a point where you were a little over a percentage of ADV that you should have thought through more. So, obviously the learning there was, so I do track for like ADV and a weight, and the standard is like a 10% ADV. Okay, so like that's the standard. That's like your hard risk limit. But the thing is, this stock kept going down in price, and so what happened was it ended up being where like the volumes had just begun to drop, and so even a 2% ADV had a massive transaction cost. So that was a risk that I didn't properly assess at the time. And so you are always going to learn. You're always going to like see things like that. But it's really important to. So like I could have taken away that, like the takeaway could have been, oh, I was stupid to panic, right? Out of something like that, right? But actually, like this was the ultimate feedback was like, no, I was right to panic. Like you should trim risk if you're worried that this is. No one wants a Volkswagen trade, okay? Like no one wants that to happen, right? Or a GameStop. So you should cut risk, but my posture in the first hand was unnecessary. That was the the important thing. So it's really important that we think about risk multidimensionally. We're gonna constantly be adding more you're gonna cycle through every year it's a little different, right? So there's always going to be new things that come up. The most important thing is that like you don't dwell on it too much. You learn, you apply, you add the learning to your process, and then you move on. So I think I'm happy to kind of share more mistakes that I made, but that I felt was like a really good one. Oh, the best part, my thesis hit for that stock. It went down even much more. It actually the remaining. So at the end of the day, I actually ended up making a ton of money on the trade, but I had lost so much because of that stupid, spike. If I hadn't done that, right, I would have made a lot more. But even if I had it set up, better, I probably would have, had some issues. So, that was the lesson there. Looks like Andy has a head out. I actually have to. I gotta wrap up too. I didn't realize that we had already hit 5:30 on my end. Before we do wrap it up, did anyone else want to chime in and add something?
I got a trade idea to bring tomorrow or Monday.
Let's do it.
We have to do it now. It'll take some time to walk through, but we can do it tomorrow.
Okay, no, that
It's
sounds
fine.
good. Looking forward to it. Okay, guys, I'm gonna hop off. Good catch up with everyone. Talk to you guys
All right.
then.
Thanks.
See you.
Bye, everyone.